Hey guys, welcome to another Trade Genius podcast. Hey, we're going to go over the quarterly refunding announcement. Is Yellen going to keep pumping this market? And we're also going to talk about today's reaction to the FOMC rate announcement. Let's dive in.
Trade Genius.
Hey buddy, it's Bob with Trade Genius. Hey, it is holiday season and our holiday specials are running right now. Use promo code HOLIDAY. You already blew it. You missed the Black Friday specials, but this is your second chance to take advantage of some of the best pricing that we do for the year. Check us out, tradelikeagenius.com, tradegenius.co, tradegeniusacademy.com. All roads lead to Trade Genius. Check us out. Incredible deals. Thanks for listening.
All right, guys. So this morning we got our quarterly refunding announcement, or QRA, and that's been really important because of the amount of T-bills that have been issued. And in this market, T-bills means liquidity. So they've been really pressing the amount of T-bills, and that has been helping the market stay afloat. So what did they announce? Well, in essence, the amount of long-term debt is marginally staying the same. However, the amount of T-bills being issued over the next 2 quarters is quite a bit less. Now, they're doing this because they anticipate a higher amount of tax receipts in Q2, but I do think that the T-bill issuance being lower is going to have a material effect on the market. Now, most notably, the reverse repo window was scheduled to be drained if the T-bill issuance was going to stay at the levels it had been, probably by late February, early March. And then there was some talk that the Fed would have to basically wind down or lighten the quantitative tapering that they've been doing, because then they would have to provide some sort of liquidity in place of the reverse repo. So if they started to back away from the tapering, or at least the amount that they've been tapering, that would help liquidity in the market. So essentially that means that they don't have to do that. So the quantitative tapering looks like it'll continue at the pace it has been. And on net, this means we probably have less liquidity in terms of that Fed net liquidity that we've shown you guys going forward. So this would be more supportive of a pullback from that seasonal window of the back half of February after the OPEX going down into March. So I do expect to see a higher likelihood of a pullback into that. In terms of the FOMC, all right, transitioning to the FOMC. So Powell came out swinging and really bipolar, right? I mean, he was hawkish and then dovish on the last meeting and then hawkish again this meeting. But basically what they said was, don't expect rate cuts as soon as you guys seem to be pricing it in. And the markets retreated on him being hawkish. And now we're trading down here at about 48.71 on the ES futures, which are trading about 30 points higher than the actual SPX itself. So the key level, I think, for what's going on here, I mean, we're getting a pullback. You know, I like to see markets hold over the 9 EMA when they're trending. We obviously broke through that. That's this blue line here. And now we're getting basically a push down into this potentially support area, which is between 48.68 or so and about 48.74. If this zone doesn't hold, you'll notice we had pretty one-sided auction coming up as we broke out over this 48.40 level. So this could start to backfill in if we don't get a bounce off of this level. And that's where I would look for essentially some sort of support coming in at 48.33 to 48.40. If that doesn't happen, essentially what we're going to do is start breaking the 4,800 level on the SPX. So that's the index itself. Again, this is the futures chart. It trades about 30 points higher. So that definitely could start an unwind deeper. Now we are in a zone where OPEX going into February gives us tailwinds, but if we get a break of that level here, this lower green area, that could actually start to kind of compound the downside, and where you get into an environment where selling begets selling, and then dealers have to hedge, and you get basically a snowball effect down. But that doesn't really come into play until this breaks. Now, we can't even discuss that until this upper green area is broken or not. And currently we're getting support there. So this is something we're going into tomorrow's session. You'll have to take a look at that. Do I think that the highs are in and we're rolling over and, you know, the hawkish Fed is going to kill this market? I really don't. I still think we, unless we get a severe break lower here, I just think that right now the flows are positive, and I think we're going to still continue to see an attempt to make higher highs in this market. However, going past the middle of February, we do have a dangerous window there, and I do think that certain things are in play that could help us get to a pullback in March that goes deeper than this. And then we'll take it from there. You know, if we do get traction and we start getting a bounce after March, then you could make one more run toward the highs, maybe even more highs after that. But then I think we have to start looking really at the fundamentals here. And I think at some point, the data with the growth in the economy, the jobs data, you know, we got more and more layoffs being reported. You know, at some point, the market's going to start to price that in. And we're going to really take a look at TLT and things like that to see if we're getting that divergence from equities and TLT, because I think really that's going to be the tell. You can't, you know, the big money can't hide when they're going to start to push that up and you get that divergence that we've been talking about for the last few weeks. So basically here, guys, Powell nuked the market. Bears are in control under that 9 EMA. In terms of like Bitcoin, if we take a look at that, in a pocket of support here from 42,336 on up to 42,773. We were holding over that 50 SMA on the daily, and that has broken because that's up there at about 42,800. Bulls would really want a daily close over that. Looked like we were doing pretty well until Powell came in and the algo sold off of his comments, off of his hawkish comments. So I wanted to give you guys kind of an update on in terms of what happened with Yellen's announcement, which was also negative for liquidity over the next couple of quarters. And then Powell came in as well with a double whammy. So I think, you know, there's some pullbacks that we have to face in terms of today's action, and whether or not that manifests into a deeper pullback before February OPEX, that's still up in the air. And I think you have to kind of give it to at least the bulls in terms of if we're still trading over 4,800 on SPX, then you have that opportunity to move up into that February OPEX. Otherwise, beyond that February OPEX, I think you have to be very, very, very careful of this market because A, you have less T-bills, which is less fuel, and you have Powell saying that it's higher for longer, basically. All right. So seasonally, not a great spot to be in, especially when you don't have the fuel that you had prior to this. So again, less T-bills over the next couple of quarters and Powell higher for longer. So going into middle February into middle of March, not so hot. There you guys have it. There's the levels I'm looking at for support, and we'll see if they hold into tomorrow on those. Otherwise, let me know your thoughts below. Was this helpful? Let me know where you think the markets are headed going into the middle of February, and if you agree that we're dropping into March. I'll talk to you guys in the next episode. If you guys need help navigating these markets, head over to tradegenius.co. Check out our packages over there. Otherwise, guys, please hit like and subscribe. Smash that notification bell. It really helps us out. And I will see you on the next video. Take care.
Trade Genius.